Welcome back! We are on module 2 of the first time homebuyer course. So in this module, we're going to address the most crucial factor enabling the purchase of your home, which is your credit. Make sure slides are on. There we go. So we're going to guide you through everything you need to either build or repair your credit, ensuring that it won't hinder your ability to purchase a home when the time comes. So unfortunately, we all know we definitely don't do enough to teach people the basics of credit and the impact that having no credit or poor credit can have on your life. And this goes far beyond from just qualifying for a mortgage. It can also hinder you from purchasing a vehicle or renting a home. And so let's just demystify credit once and for all so that it doesn't hold you back ever again. So in Canada, our creditworthiness is primarily evaluated by two prominent institutions. We have TransUnion and Equifax. Your credit report encompasses various aspects, including financial habits, employment history, residential records, credit responsibility, and more. So essentially, it represents a comprehensive record of your life. And when seeking any type of financing, all financial institutions will request your credit report to determine your beacon score, commonly known as the FICO score or credit score. And this serves as the fundamental measure for financial institutions to evaluate eligibility for financing. Beacon score, FICO score. So, equally crucial as the score itself is the information contained within your credit report, which we are going to get into. But first, your beacon score. The beacon score is determined by an algorithm composed of these 5 key factors. We have payment history, utilization, credit history, credit mix, and new credit applications. So we're going to go through each of those right now. Starting with payment history. Payment history, the most critical aspect of your score, represents 35% of your overall beacon score. So each missed payment is reflected in your history, allowing us to trace when the missed payment occurred on your credit facility. So maintaining and building good credit involves adhering to the contract terms and consistently paying your bills on time. We got number 2, utilization. This represents roughly about 30% of your overall beacon score. And this refers to the extent of your available credit that you use and the balances that you carry. So it's crucial to keep your balances on revolving credit below 50% of the available limit. So approaching or exceeding your credit limit can significantly impact your beacon score, causing it to decrease. Revolving credit, I just want to mention, is like, credit cards, lines of credit, anything that goes up and down as you pay it. That's revolving credit. So number 3, we've got credit history. So this represents 15% of your beacon score, and it tracks the length of time your credit accounts have been active. So the longer your credit history, the better. This is why you never close old accounts, especially ones with a good repayment history. Now we have number 4, credit mix. This represents about 10% of your overall score, and it looks at the variety of credit accounts. So loans, credit cards, mortgages, car loan, things like that. A more diverse portfolio can positively influence your score. And lastly, we've got new credit. I don't know why it has the thumbs up, but it does now. Your new credit this represents 10% of your score, and it's triggered by if you continuously are seeking new credit. So by applying for multiple forms of credit, you can negatively impact your score. And additionally, the quality of the credit matters. For instance, different credit cards, like a Capital One card versus a TD Bank Visa, hold different weights in the evaluations. Certain types of loans, such as an easy financial loan, can indicate desperation or a lack of understanding of credit overall, and it ends up affecting the perception of your credit, so how your credit looks in the credit report. So now that we know how the algorithm determines our credit scores, let's look at the Beacon score ranges. As you can see in this chart, anything above 670 is considered good. And ideally, you want to have a score above 680. However, we do have lenders and insurers who will look at a lower score, but it will come down to the history and the information contained in your report. So keep in mind, a higher score generally translates to lower interest rates, which then affects the cost of borrowing. So always aim for a score above 680. So how do we achieve a good Beacon score and a robust report? We follow this golden rule of 2-2-2. So most financial institutions look to see the following within your report. We want 2 forms of credit. So this could be a line of credit, a car loan, a credit card, a mortgage. As long as there's 2 forms of credit, any 2 types, and then we want to have each of those forms of credit to be reporting to your credit bureau for at least 2 years, which means you're holding them and you're using them over 2 years. And lastly, you want to have the minimum available credit limit of $2,000 on each of those forms of credit. So if you follow these guidelines, you will be well on your way to good credit. But what happens if you have damaged your credit? The good news is you can repair your credit quickly with these strategies. I'm going to go over them. As mentioned previously, credit utilization, the amount of debt you carry, accounts for 30% of your overall Beacon score. So clearing debt on revolving credit, like credit cards, can often lead to a quick rebound in your Beacon score, provided that there are no delinquent payments. However, if your debt is substantial and requires a more structured approach, I recommend either using the snowball method or the avalanche method to pay off debt. So the snowball method focuses on paying off the smallest debt first, then adding that monthly payment that you were paying on that small debt towards the next debt. This lets you pay more each month on the following debt, clearing it faster. Also, mentally, it boosts your confidence when you see a debt fully paid, hopefully motivating you to keep tackling your debt. The avalanche method, on the other side, involves prioritizing the debt with the highest interest. So by allocating more money to the highest interest rate first, you end up paying fewer interest fees on that card. And this method saves money, but it may take longer to pay off the debts. Whatever method you choose, paying off debt helps repair your credit and increases your eligibility for a larger mortgage when the time comes. So if your lower Beacon score is not due to high balance, but rather to a poor repayment history, it is crucial to pay all of your debts on time according to their due dates. This also includes even bills like your cell phone bills. Repairing credit due to a delinquent payment history typically takes a little bit longer. However, by starting today and committing to paying on time, within 12 months, you will see a substantial improvement in your credit score. And this responsible behavior also demonstrates to lenders that you can manage credit responsibly. The good news is, when it comes to purchasing a home, you don't necessarily need excellent credit. Good credit will suffice. As a mortgage agent, we have access to over 30 different lenders, ensuring that you can find a suitable match for each person based on their unique profile. So, up next, we are going to go through income requirements for the mortgage application. And we're going to go right into it. So Module 3, welcome. We're going to focus on the next key factor for qualifying for your mortgage, which is your income. So as mentioned in our previous module, we highlighted the significance of maintaining a solid credit score before embarking on your home ownership journey. Now, we're going to explore how your income structure plays a pivotal role in determining the mortgage amount that you qualify for. So, to assess your mortgage eligibility and the amount you can qualify for, lenders will look at your total annual income, its source, your employment duration in your current position. So lenders typically categorize income into 4 main types. We've got part-time, full-time, contract, and self-employed. So although each lender has specific criteria for evaluating these income types, a common requirement is a 2-year history for all of them, except for individuals with a guaranteed salary and you're not on probation. So for those that are earning hourly wages, lenders generally look for a 2-year history to calculate an average income over that period. To prove your 2-year income, you will be required to provide your last 2 years T4 slips, a letter of employment, and your most recent pay stub. If you're salaried, this is probably the easiest form of income to prove. Typically, we only need a letter of employment and your last 2 pay stubs will suffice. However, for both hourly and salaried, if we need to use overtime, bonus, commission income, in addition to your base earnings, we will require your last 2 years of T4 slips with the corresponding notice of assessments. For our self-employed individuals, this is solo proprietors or even individuals who are incorporated. Many of our lenders provide specialized programs to help you qualify for a mortgage. These programs acknowledge that the income structure and tax claims of your self-employed individuals might not completely represent your financial status. So, we will evaluate your unique situation to identify the most appropriate program and lender that will be best suited to your income. For both sole proprietors and incorporated individuals, you will be required to provide, both of you, your last 2 years of T1 generals with the corresponding notice of assessments. And then if you're incorporated, in addition to those 2, we also are going to need you to show your articles of incorporation and your last 2 years of corporate financial statements, or T2s. So, besides traditional income sources, lenders may also consider additional types of income. So these include commission sales, bonus income, spousal or child support, disability or pension, child tax benefits, vehicle allowance, rental income, particularly if the property in question has rental potential. Once we know how much income we can use, we can then determine your mortgage capacity and the amount of mortgage you qualify for. So lenders will look at your income and debts to establish your maximum mortgage amount. And this calculation is known as the debt servicing ratio. The ratios calculated within this are known as your gross debt service ratio and your total debt service ratio. And here they are. So your GDS, gross debt servicing ratio, measures the portion of your gross income necessary to cover housing expenses like mortgage payments, property taxes, heating costs, potentially half of condo fees if applicable. While your TDS, your total debt servicing, considers all of those housing costs that we calculated in the GDS, along with your other outstanding debts like car loans, credit card debts, line of credit, personal loans, etc. And these ratios evaluate your capability to manage mortgage payments and other debts without overwhelming your financial situation. we will use your income, your ratios, and down payment to determine the maximum mortgage amount that you qualify for. And that completes module 3. Up next, we are going to dive into down payments and everything you need to know about the minimum amount required and rules around documentation. So we're going to get into that into the next session. All right, thank you.